Do you think that opportunity that you had in 1979 still exists in 2023?
Seth Klarman would be near the top of the list as an example of smart money in the markets. The Baupost Group, a Boston-based fund manager with a reputation on Wall Street for averaging a 20% yearly return since its founding in 1982, employs the low-profile hedge fund manager as its chief investment officer. Keep watching this video to know more about Klarman's message on investing in the current economy. The devout value investor and manager of approximately $25 billion or $37 billion, Klarman rarely addresses the public. Thus, his visit on the Capital Allocators podcast this week offers a unique chance to learn about his upbringing, his love of baseball and horse racing, and his opinions on the markets. Klarman admits that he's currently more than a bit perplexed.
You need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow up is because of leverage.
Since I've been in the investment business for more than 40 years, he continues that this era is one of the weirdest times he's seen in his life. Seth Klarman says in an interview after the release of the 7th edition of Benjamin Graham and David Dodd's Security Analysis, which has advised some of the world's most successful investors, including Warren Buffett, there's a little bit of sacrilege in my chapter on the balance sheet, which is basically saying that we ought to rethink this. In 1950 and 1951, Graham and Dodd themselves taught Buffett security analysis at Columbia University. Value investing is fundamentally about paying less for something than it's actually worth. Yes, we've all heard the amazing facts about the supremacy of the Magnificent Seven AI-powered stocks during this rise, which include Apple, Amazon, Alphabet, Meta Platforms, Microsoft, Nvidia, and Tesla. The equities, which have contributed to more than 70% of the S&P 500 gains this year, have a combined market value that's almost equal to half of the US GDP. These 7 stocks, however, are not fly-by-night operators. According to the Bank of America, their profits are predicted to increase by nearly 20% in the June quarter, while those of the rest of the S&P 500 are predicted to decline by roughly 10%. This means that they're predicted to account for more than 100% of the growth in US corporate earnings. But while so-called dumb money is having a party in 2021, smart money like Klarman is growing uneasy. The difference between how professional investors and retail investors view equities has grown to a level that's not been seen since the turn of the century, according to the most recent fund manager poll from the Bank of America. Graham had to contend with cycles of change. According to Klarman, who edited the most recent issue of Security Analysis, it is much more likely in this world that his earnings will go to organizations like Girls Who Invest, UNCF's Lighted Pathways program, and sponsors for educational opportunity that are seeking to enhance diversity in asset management and finance in general. The famous chapter's introduction by Klarman states, among other things, that investors no longer benefit from studying publicly available balance sheets. The advantage has been destroyed by intense rivalry from professional investors willing to spend astronomical sums on research and development in search of a competitive edge, as well as by accessibility to unlimited sources of financial data and information to everyone. Technology has been the biggest transformation for investors trying to estimate a margin of safety from balance sheets. According to Klarman, portfolios are more at risk from technology in all of its manifestations than even a protected market collapse. He asked during the interview, what is technology doing to this business? Is it helping this business, or is it killing off this business? Although he may believe balance sheet analysis is less relevant, Klarman, who first became a proponent of value investing during a summer work at Max Heinz Mutual Shares, isn't dismissing it. He contends that the study shows investors how indebted a firm is, or how much cash it has, and aids in spotting warning signs such as whether liabilities are expanding more quickly than the company itself. He states in the chapter's opening that while Graham and Dodd's emphasis on book value may have been replaced by newer metrics, their emphasis on balance sheet analysis is still relevant today. The timing was appropriate to go over security analysis once more. According to Klarman, he agreed to edit the book to serve as a reminder to readers that adhering to some fundamental principles could help them avoid difficulty. He thinks that over the past 15 years, more so than during previous bull markets, the markets have evolved into a place where investors can speculate. Although he feels it is his duty to alert investors to the risks, he fears that the largest pension funds and endowments may choose to do otherwise. I'm unsure of how much this will be read by institutional investors, who could assume they're experts in everything. In answer to a query, Klarman muses on what he believes to be a more appropriate parallel and states softly that security analysis is not a how-to guide for investors. I think maybe it's like a Marine Corps training manual, and what it basically says is, maintain a nutritious diet, remain in excellent shape, run 10 miles whenever you get the chance, and be true to your teammates on the squad. It's like a plan, a framework for how to approach investing, because it doesn't tell you what stocks to buy or the appropriate pricing. The most popular and possibly intuitive method of investing is value, but it isn't the largest. It requires patience and goes against a lot of conventional knowledge. Both skeptics and believers are skeptical that investors can stick with a strategy that frequently has to endure protracted periods of underperformance. Despite decades of scholarly arguments to the contrary, value investors think there are opportunities in cheap equities because markets are inefficient. Value believers blame the cognitive mistakes that people frequently make, such as the urge to fit in and follow trends, to mention just a few, for the inefficiency. And supporters of value do not believe that human behavior will alter. Critics claim that the world has changed during the protracted period of value underperformance that ended in late 2021 or early 2022, and that the move from businesses operating manufacturing plants to less tangible, more difficult to price assets, such as intellectual property, had destroyed value investing. Then, just when investors thought to have lost in style once more, value came roaring back. In an interview with Institutional Investor, Klarman readily slid into utilizing the principles behind the approach to define anything from the permanence of market inefficiency and human behavior outside of finance to the question of whether one can learn to be a value investor or must be born that way. Between knowing when and how to adapt and adhering to tried and true discipline like balance sheet analysis, there is frequent tension. How can you distinguish reality and timeless knowledge from that which is transitory, protean, and illusory is a question posed by Klarman in the foreword to the 7th edition. Since the beginning of Baupost in 1982, Klarman has repeatedly dealt with this issue, despite the fact that many of his famous peers either abandoned value when it appeared that it would never work again, or just changed the rules to accommodate the opportunities present in the market. This is thus because both analysis and human psychology play a role in value investing. Many would even argue that it's true of all investing. Some actions necessitate apparent logical inconsistencies. According to Klarman, individuals must be equally willing to let go of a deeply held belief and change their minds. Baupost has implemented several procedures to safeguard people from themselves in order to solve this issue, as well as other behaviors that can cause value investors to run into trouble. For instance, Klarman makes the final investment decisions after taking a wide view of the various industries to identify beat-up areas and long-term prospects. The firm's around 60 analysis then go deeply into certain concepts, but they also need to be aware of the conclusion. According to Klarman, it may be easy as an investor finding something better or realizing after they've invested in an opportunity that it's not exactly what they expected. Even if the cost has increased, leaving is preferable to merely remaining. Baupost demands what it calls a rebuy analysis to combat the intrinsic human capacity for coming up with justifications to stay on their ideas despite negative or changing news. Analysis underwrite current investments when circumstances alter using the fresh data. Would they invest in the same things today? The goal of Baupost is to retain investments until they're no longer a worthwhile investment, not to hold them indefinitely. Market inefficiency, according to Klarman, is due to the persistence of cognitive biases, despite Baupost's best effort to combat them. The efficient market hypothesis, which holds that all available information is factored into stock prices and that nothing can be purchased for less than its fair worth, was not widely accepted when security analysis was first published. The 7th edition contributor, Howard Marks, co-chairman of Oaktree Capital Management, says that he was fortunate to be a Wharton undergraduate in the middle of the 1960s because the finance theory that emerged from the University of Chicago Graduate School of Business was still relatively undeveloped and underutilized. And with that, we come to the end of this video. Leave your valuable comments down below and don't forget to like, share, and subscribe to this channel.